And where are you going to go? I mean, bonds look terrible. Cash looks terrible. You want to be in real assets. Profits are doing extremely well. So even though there's fear of a Fed rate hike, and I actually think they're going to have to be much more aggressive than what the market is pointing out so far, I still think stocks are the place to be next year. I don't think it's going to be as good as this year. I think we're going to probably have a 10% gain in S&P, plus or minus, as they contend with a more aggressive Fed. But real assets are still the place to be.
You're the second person on this show to say that in the last hour. John Rogers of Ariel said more than 3 rate hikes from the Fed next year to deal with higher inflation. How many do you expect?
Well, believe it or not, I think we may have to get to 2% on Fed funds. Now, if you measure them in quarter points, that's 8. But it seems to me, how are you going to fight a 5-6% inflation, which I still think is going to rage next year, unless you start moving it up more aggressively? I don't think the long bond is going to move up that much. I think we may even have an inverted yield curve by the end of the year or early in 2023. So you shouldn't look at the 10-year. I think it's the short rate the Fed is going to have to operate on to move up the interest rate. Slow credit growth, that's it. Money supply growth has to be slowed to actually tackle inflation.
So I just want to be clear. You expect 8 rate hikes if we're looking at 25 basis point hikes from the Fed, and the market to go up in that kind of environment?
Believe it or not, if the long bond stays at 2 and the short rate is 2 and inflation is 5 and profits are going up 5 to 10, where do you want to be? I know it sounds scary to think about, oh my God, 8 rate hikes. But, I'm old enough to remember a 2% Fed funds rate is like, oh my God, that's so low. Who would ever go into cash or bonds? So it's still, from a historical perspective, very, very low. But I cannot see 90 basis points, which is the Fed dot plot, being, effective at slowing credit growth or effective at slowing demand and the inflationary pressure. So,
but we're also going to have fiscal stimulus withdrawal, aren't we? Isn't that going to help pressure not just inflation, but also cool off the economy a little bit?
It will definitely do that, but there's still a lot of money in people's pockets that was created during the COVID fiscal policy. Money supply is up 35% from where it was pre-COVID. That money is going into stocks. It's going into commodities. It's going into inflation. I've been, as you know, Sarah, a real hawk on inflation for months.
You have, and you've been right so far. I'll give it to you.
And I think we're going to have another 5-6% inflation in the coming year. And the Fed is going to have to say, you know what, I have to step on the brake harder.
I would say that's out of consensus, because a lot of people do think these supply constraints are already easing and they're getting better. We've heard as much. FedEx CEO said as much to the White House this week, and that's a big chunk of it, don't you think?
Some of it is supply, but don't forget, even when you take a look at these commodity price, people are saying, hey, do you notice that gas has gone down? Oil has retraced almost half its drop. And some people are still pointing to oil being 80, 90. I've heard 100. Lumber came all the way down. Lumber is back up. Housing prices are not going down. The labor shortage is not going down. That's much more key than some of these delivery problems that we've been hearing about. Because if labor is going to go up 5, 6, 7, 8%, we don't have the productivity to keep inflation at 2% under those circumstances.
Well, I mentioned with Ariel Investments Chairman John Rogers last hour. We talked about this very issue, how higher interest rates are going to play out and what they're going to do to the economy next year. Here's what John Rogers says.
I think we're going to be fine. I think the economy is still quite strong. I think the higher rates will not be enough to slow down this economic recovery. And again, these undervalued stocks that are selling at single-digit PEs, often selling at such a discount to the S&P, are well positioned to do extraordinarily well.
Professor Siegel, do you agree that the value stock, the cheaper parts of the market, will work?
I absolutely. So even though the Fed is going to have to be more aggressive from a historical standpoint, they're still easy. Demand and money is there. And I think, and profits are going to be there. Firms are leveraged. They're borrowing at negative real interest rates. They have labor contracts. Now, some of those are going to be negotiated upward, but, they're getting the real cost of labor is going down to some of the firms until we're going to get catch up later in the year. And that's why I think this inflation problem has to be addressed more aggressively. But in the meantime, stocks are still the place to be and profits are still going up.
Steph, what do you make of these calls? Very high inflation call from Professor Siegel and 8 rate hikes next year.
Well, we've been talking about inflation. Not all of it was temporary. We've been talking about this all year long, Sarah, and we've had that discussion. And so, yes, maybe commodity prices can come down a bit. Maybe we get the supply chain fixes. They come in a little bit more. We'll have to wait and see. We're going to be very data dependent. That's my theme for 2022, by the way. But on the flip side, as Professor Siegel said, rents are going higher. That's very sticky, and that follows home prices. And home prices, the median price increase is up 18%. So, and usually rents follow home prices by 12 to 18 months. So that is definitely stickier. And then, of course, wages. We're seeing it across the board. I mean, that unit labor cost number that we got for last quarter was just astounding. I've never seen such a high number before. So I do think you're going to have inflation. But I don't think it's runaway inflation. I do think productivity plays a part, even though last quarter productivity was disappointing. But I feel like we are going to have above average, but not enough to have eight hikes. That seems to me like a lot. And I don't know if they necessarily have to do 8 hikes. Why don't if they can stick to the 3 times that they're going to actually raise? Maybe they do a little bit more, and they can dial
like 50
it up
basis
or
points.
back as needed. Yeah, absolutely.
But you know what? I just got to interrupt, Professor Siegel, because someone should tell the bond market, the TIPS market, that's what tracks inflation in the bond market, and it's not predicting the kind of levels that you're talking about.
Well, don't forget, there's 10-year inflation. Don't forget that 10-year bond has become a real hedge asset for so many investors. They just hold it because we know if the Dow goes down 1,000 points or 2,000 points, treasuries are up. It's an insurance policy. I don't think it's giving unbiased estimates of what inflation is, and it is 10 years out. If you look at 1-year tips, 2-year tips, they are looking at 5-6% inflation, 7% even on the short end. And don't forget, 8 I know sounds scary, but if 8 quarter little baby steps is 2%, and from history, that's not at all scary.
But this has been a market that's been conditioned on liquidity and zero interest rates for a long time. Finally, what does it all mean for tech? So do you want to stay out of big cap tech, unprofitable tech, anything with higher valuations next year?
Well, I do think to get a rotation to value, because when we have those rate increases and people are not getting zero all the time in their bank accounts and everything like that, the firms, they can say, well, where are the earnings, or where is the cash flow, and where are the dividends? And we've seen a come down in the last 3 months. So much of the so-called high flyers into the conservative tech. Last year I thought we'd have a rotation in value. Value did lag growth, if you take a look at the Russell indices, by about 2 or 3 percentage points this year. But I think, given relative valuations, so many stocks are selling 10, 15 times earnings. In this environment, they look really attractive to me. Value, I think, outperforms the growth in 2022.
Quite a few calls. Jeremy Siegel, come into play today. Thank you for joining us.
Thank you very much.
And
Happy
Steph,
holidays.
Happy holidays to you. Steph, before we let you go, we wanted to